Ladies and gentlemen, welcome back to the channel. We need to get into all of this information here on the day with AMC Stock as well as the broader markets. As you guys do know, the UAW strike is getting worse. This is adding more pressure on the economy with 7,000 additional employees that are going on strike here today. We also have a government shutdown, which looks almost certain to go in effect here on, I believe that is going to be Sunday on October 1st. So we have all of this information to bring to you guys. We're going to look at bonds. We're going to look at oil. We're going to look at the dollar and talk about AMC stock. We are not, at the time of recording this video, seeing a ramp into the end of the day, but you are still green as even the markets are slightly in the red, at least at the time of recording this video. So we have a lot to get into in a very short amount of time. I know you will learn something. If you want to learn something, you want to grow your knowledge base and come be part of the action, well, hit that subscribe button as well as comment down below. Let me know what you guys think about all of this information. So first things first, I want to point out again, today is the end of fiscal year 2023. The risk to reward to be short in AMC does not make a lot of sense heading into fiscal year 2024, but that does not mean hedge funds, institutions use their brains in regards to their positioning in stocks, such as AMC. Does not look like we're seeing a lot of shorts covering. It does look like we are seeing some hedges for an upside move via the options market. We'll take a look at the Stocko tracker data because you are definitely seeing an outsized amount of calls being purchased today and seeing an outsized amount of just calls on the future expirations as a whole. But you're not seeing that end of the day kind of ramp that I thought was possible. Now, at one point today, we were up a lot more on AMC stock. At one point today, you were at $8.31 per share. You were up like 7-ish% at one point. So in a weird way, you did kind of see that ramp. It just happened in the beginning of the trading day. Now, by the time you guys are seeing this video, the numbers here might look a little bit different. If we do get volatility in the last half an hour of trading or so, AMC stock right now is up about 1% at $7.87 per share, including the move in after hours. We really want to see if at least we get above $8 per share and can close above there, because that's where you're going to have like 15,000 options that are held in open interest that do expire into the money. That will cause a lot of hedging and just overall buying of shares even 2 days from now. So even on Monday and Tuesday of next week, you could still be seeing some of these option positions being fully hedged for and see transactions moving around for this week's option expiration. Now, for today, you are seeing volume so far of about 14.8 million. Pretty low volume has fallen, obviously, since the stock has fallen. And that's one of the reasons why you're just not seeing super high cost to borrow fees here for AMC stock. That's one of the reasons, because you really haven't seen that much upside volatility. And today's cost to borrow fee is about 14%, so higher than what they have been recently, but still not that crazy high in the grand scope of things. We were, hundreds of percents, 1,000+% just like 2-3 months ago. So the numbers have dropped off a lot. I do expect if that upside volatility does come back, that AMC's cost to borrow fees will also increase as well. So that is something I am watching for. We are seeing some weird numbers over here on Ortex as well. You have 21.77 million shares that are estimated to be sold short with a short interest of 11%. But if we take a look at these other estimates, you do have 27.25 million shares that are estimated to be sold short. So I don't know which number it is, but it's a high number. You have the most amount of shares that have ever been sold short, but the float is larger now because AMC has issued 40 million additional shares. So the short interest percentage looks lower. We'll have to see. Did retail buy those shares, those 40 million shares? Did hedge funds and institutions buy them? Did they short them? We just don't know as of right now. So there's a lot of questions that are still yet to be answered. Hopefully they will be answered here in the next couple of days or so. Now, if we take a look at the dollar amount currently estimated to be sold short, $172.28 million. Estimated short interest of free float at 11.18%. Free float out on loan at 13.78%. Shares out on loan 27.25 million. Days to cover 1.9. Cost to borrow 3.59%. And utilization of 59.73. So decent numbers here, but again, it's nothing compared to what we have seen with a short score of 65.35. Now, a lot of people ask me, is the MOAS dead at this point? Obviously, it's not. AMC is one of those stocks that is like a Tesla or is like another stock in terms of trades and a short squeeze. Everyone knows about GME and AMC, right? So when those stocks do start to actually see runs again, that can draw a lot of money into those stocks, even for people that have not been a part of them in a very long time, just because people know the kind of volatility that you can see, the kind of up move that is possible here. I do think that keeps quite a few people on the sideline, especially as AMC has been falling, but any upside volatility likely can have a huge follow through compared to some random stock out there nobody cares about. So I think that's another big factor to take into consideration. Again, the amount of shares currently sold short is at the highest level it has been at as well. So very much, I do still think a squeeze is here. Coming at some point, I just don't know when. Now, if we take a look at the option activity here, you got about 6,000 calls currently in the money expiring today, 125,000 calls out the money. In the money puts at 16,000, out the money puts at 37,000. Now, this is for today. So, like I said, you may or may not see the last couple of minutes, the last half an hour or so be volatile to the upside. It would not surprise me to see AMC stocks still close up 5+%. That just wouldn't come across to me as super shocking, given the risk reward looks really bad for fiscal year 2024. I said this in the last video, and I think it's a great way to think about it. But if you're short in AMC right now, sure, could AMC fall to $5 per share? Could you lose $3 or so per share? Obviously, you could, but AMC stock could go to 20. I think easier than it could go to $5. So your risk reward just does not look good after AMC stock has fallen 90+% from the highs, or just even 80+% from where it was just a couple of months ago. Sure, we have gotten dilution, but does that really justify the 80+% sell-off we have seen? I would argue probably not. And what we're seeing over the next couple of expirations as well, like basically all of them here on the chain, people switch from being, 2-to-1 for puts relative to calls. Now it's switched. Now it's like 2-to-1 calls compared to puts. And if you take a look at Ortex here with the put to call ratio, you can see the put to call ratio was as high as about 1.8. And now it's at 0.79, which is kind of in line with what we've seen back in November and December of 2022. Now, to get back to a level where we were at when AMC stock was performing well, or at least going through rallies, that was about 0.54 to about 0.72. So there's further, I think the put to call ratio will fall. As the put to call ratio does continue to fall, that's just telling you, hey, there's not as many puts out there that are going to help beat down AMC stock on a week by week basis. So do go ahead and keep that in mind. Obviously, it's not a trading strategy, but it's better to see more calls than see more puts. And I think that is pretty straightforward. Now, if you take a look at the FTD numbers, as you guys know, this week we had on Monday about 25 million FTDs, 36.5 million FTDs on Tuesday. On Wednesday, about 51 million FTDs. On Thursday, about 12,000 FTDs. And now today on Friday, you are seeing 1.8 million FTDs that do come due. Now, what I want to say here is this is not an exact science. This is an estimate. So who knows when all of these FTDs will be covered. It's not like the SEC or FINRA or anyone else really cares about AMC's FTDs. We haven't heard anything. There's no investigation. There's nothing going on that we know of. So as of right now, my best judgment says nobody really cares about AMC FTDs. So it could be dragged out a little bit longer than the typical T+35 settlement time. It's one of those things where if a institution had 1 million FTDs that were due, it's not like you're seeing any action being taken against them or any kind of investigation at all. So that's something to keep in mind as well, guys. So there you have that. As far as what's going on here in the markets today, oil is down about 1%. Stocks are slipping into the end of trading. And again, I think it's one of those scenarios where on AMC, the risk reward makes a lot of sense to be long. In the markets, the risk to reward makes a lot of sense to be short, have some hedges, or take some profits. So your last day of fiscal year 2023, I did not expect to be a positive day. Now, we did get some positive news today here in pre-market, like PCE that came in at 0.1% month over month on the core. You were expecting 0.2%. The initial algorithmic reaction was positive. But now, once people are like, hey, what am I going to do with this position? This position, this position, my portfolio as a whole, I think a lot of hedge funds and institutions are opting to hedge their portfolios to sell some stock heading into fiscal year 2024. And then when you consider all of the negative things that are currently going on right now, again, the spike in energy, every recession you have seen since 1945, the end of World War II, you have always seen a spike in energy. You can make the argument that you've seen the spike in energy back here in 2022, but people had so much money they just continue to spend. It delayed the recession, and maybe until now. Or you can argue that was just a fluke spike in oil because of inflation. And you could argue the spike in oil before a recession is coming now, as oil has risen almost 40% from the level you have seen in July. This was not like a slow trend upwards. This is what I would call a spike. No doubt about it. What you're also seeing is a surging 10-year treasury yield as the short end of the curve remains pretty stable. So the 2-year treasury is down about 2 basis points today. The 10-year treasury is about flat on the day. So that actually means the yield curve is continuing to uninvert today. And if you look at the 10-year and the 2-year yield curve inversion, you'll find that it's inverted 0.45%. Now, you were inverted at one point, over 1%. So you have uninverted about 50% of the total inversion that you had seen so far. Now, what that means and what you guys really need to know is take a look at this chart. Anytime that you get under this black line that you're inverted, usually during the inversion is not bad. Like 06, 2006, you were inverted throughout all of this. 2007, fine. It's when you started to uninvert towards May of 2007. November, December of 2007. That's where the problem was. So it was actually the uninversion where you actually seen the problem. Same thing back here in the 2000s, right? You were inverted in April of 2000. We know what happened towards the end of the year 2000. You started to go into a downturn in the markets and a subsequent recession. What happened? The yield curve uninverted. Same thing back here in the 90s, right? It's foolproof. It happens every single time. Same thing even before COVID, right? You actually went inverted on the yield curve back here August of 2019. Just a couple of months later, you had the COVID recession. So it's one of those situations where, I mean, history doesn't always repeat itself, but it usually does rhyme. And the rhyme here is very similar every time you hear it. If you look at the 10-year and the 3-month yield curve inversion, that is continuing to uninvert. That was inverted 1.88% at the lows. Now it's only inverted 0.97%. Again, retracing about 50% of this inversion. Same story here. When you start to actually uninvert, that's when the problem is in the market. So I think this is something the markets are grappling with. It is an issue. Now, the banking crisis. We all know what caused the banking crisis. It was yields going higher and the price of bonds falling. It works like a dividend stock. So if a dividend stock keeps the same 50-cent dollar dividend, but the stock goes from 100 to 200, well, your yield just dropped 50%. Now, if that same stock keeps the same dividend and it was 100 when you bought it, now it's 50, your dividend has increased 100%. Obviously, if you bought your shares at 100, you're obviously not getting paid more currently, but for new investors that come in, they are getting a higher yield. So bonds work just like dividends. And what you're seeing in regards to the banking crisis, banks were buying bonds here when they were, just for a rough kind of example, in the 140, 150 range, and now they're 87 here on the 10-year treasury. So they continue to fall. That's putting pressure on the collateral. If banks are not hedged out, the banking crisis could be coming back, especially if 10-year treasury yields do rise to about 5%. There's a lot of talk how the Fed might have to raise rates as high as 7% if the economy does continue to hold up. Good news is, as far as the regional bank ETF, that is up 1% here on the day. You're still trading near the lows in the grand scope of things. You haven't recovered really at all, but you're not continuing to die today. That is good. Now, oil, again, like I showed you, you have spiked. That is represented in USO. But then if you look at the dollar I would argue is even more influential than your bond yields, because bond yields obviously restrict the economy. The higher they go, the higher mortgage rates go, and auto loans and things of that nature. But when you look at the dollar, that directly affects company earnings. If you think about a Tesla, an Apple, a Microsoft, companies that do business in foreign currencies, that are multinational companies that report their earnings in US dollars, well, as the dollar goes higher, if you take in foreign currencies, convert those weak foreign currencies into a stronger dollar, that means you get less dollars. So even for the same kind of currency, same everything, if the conversion ratio goes higher, which is what you're seeing here with the dollar as of recently, ever since about mid-July, you've seen the dollar start to increase, and it's really hasn't looked back ever since. This is probably something that has influenced to stocks going down recently. It's going to make earnings a lot more difficult for companies, at least for companies to beat earnings as a whole. Now, if you look at 2022, this becomes a lot more obvious where the dollar was in 2021. I mean, this was very supportive of company earnings, right? Back here in 2021, the dollar fell a lot. That was because you had easy monetary policy. And now, not so much. Look at 2022. The dollar just soared the whole year. That's a big reason you could say the NASDAQ fell over 30% last year. And now, what do you see in 2023? Since May, even, you've seen, the dollar go up a little bit and then come right back down. Now it's rising to the highest level you have seen since back here in December of 2022. If you continue to see a move higher here, that's going to be a big problem for the land of equities. And earnings season does start here pretty soon, so that's something to keep on your radar. Now, even today, the UAW did expand their strike at Ford and GM. They cite progress with Stellantis. Now, there's two factories that are going to be shutting down. The Ford Chicago assembly plant and GM's Lansing, Michigan assembly plant, covering about 7,000 workers, said Sean Fain in an announcement here today. So you guys probably don't know this, but the GM CEO, she came out and said that for every one UAW job, there's about 6 other jobs that depend on that one UAW job. So if 7,000 additional workers just essentially got laid off that are no longer working, well, that's about 35,000 total workers that are affected there. Now, the total number of workers that are striking right now is 25,000. That means 25,000 times 6, theoretically, you're affecting around 150,000 workers here in America. And that can be dealerships, that can be detailers, that can be mechanics, that can be all kinds of different things that are those 6 other employees. So it is having a drag on the economy. Now you have the government shutdown, which is almost certainly going to go into effect on Sunday. That's going to lay off up to 800,000 government workers. They're obviously going to get the unemployment benefits because that is a state and federal program, but their earnings are going to drop for a while. If the government does stay shut down for a couple of weeks, that could be a factor that could tip the economy into a recession, mixed with these other things going on, student loan repayments coming back, obviously the surge in mortgage rates, and people are not really doing anything with their houses. They're not really selling. They're not moving. None of that. And then you obviously have this strike with Ford, GM, and Stellantis. So not a great situation, not a good setup heading into the end of this year. But I will tell you, the historical precedent is that anytime the markets have been up 10% or more heading into a down September, about 80% of the time the markets are higher by the end of the year. So historically speaking, about 80%. There's about an 80% chance, I would say, that markets do end the year higher than they are now, but this is a very unique period of time. Now, I should also point out that if the government shuts down, there's a lot of worries that we won't get data reports like CPI, like retail sales, consumer spending, things of that nature, and that's not great, because we're already, jittery about any piece of data that comes out. Now, we just might not get any data. I can't see that having a positive effect on our markets, guys. So there are some problems out here, but again, the risk to reward to be in AMC rather than other stocks makes a whole lot of sense here at these levels. So that's what I'm doing. If you guys want to come trade with me live in real time, link down below in the description of this video. You guys have a great rest of your day, and I will see you in the next one.